Yeah, Frank. Well, so we're asset allocators. So, I mean, on the show, we talk about positions in absolutes, but really it's so important to talk about them in the context of an overall portfolio. So we've been underweight tech, those positions, especially on the Qs and ARC, since last year. And so because I think as an asset allocator, looking back to December of 2021, we knew the Fed was going to be raising rates. And I'm a big believer in the Marty Zweig "don't fight the Fed" quote, because it's true. And so right now, investors, when you're putting money to work, have to understand that the Fed is pressing against the market right now because they are trying very effectively to tighten financial conditions. And so we've already had year to date 15 trillion of market cap wiped out between stocks and bonds. So the Fed has been very effective in that negative wealth effect of making investors feel their net worth going down. And so I think as it relates to tech, you have to be really sensitive to multiples, because I think we would all agree on the panel, Microsoft is a wonderful company. I own Microsoft, but is 23 times earnings the multiple the market wants to pay for that? And so I think that I would contend that the last 10 years, you had the majority, you had over 50% of stocks return from PE multiple expansion. Historically, if you go back 150 years, that number's about 15%, and dividends and earnings growth made up the more of that. And so I think as in my tech positions, I'm very settled. I have, to Josh's point, a good mental lens to say, I think the probability that multiples in tech have to come down is high. So I'm going to sit in those. It'll be uncomfortable, but that's the price of admission for investing. Because if everything in your portfolio is moving, Frank, in the same direction, you have the wrong portfolio. So while everyone's running to consumer staples, while everyone's running to everything that just is moving higher, or even energy, you have to be diversified in a portfolio. Because if nothing else, people should have learned the last 2 years, the tides change really quickly, and you don't want to chase sectors just because they feel good in the short term because they're going higher.
Yeah, we're going to talk a little bit more about tech and our Delivering Alpha stock survey coming up. But Jason, I want to come over to you. What are you seeing in the second half of the year? We look at the first half, utilities and healthcare, the best performers, tied for that first place spot. Are you looking for opportunities there or elsewhere?
Yeah, Frank. So obviously it's good to see you, man. I think there's a lot to think about here. Obviously the market was down 20%, 20+% in the first half of this year. And the Fed is obviously tightening into a slower economy. The economy is obviously slowing. You could look at housing, PMI data. I mean, all these numbers are starting to come in. Commodities are starting to roll over a bit. But I think, when you're looking towards the second half of this year and beyond, we're not going to see 8% plus inflationary prints forever. We're not going to see, all these types of pressures that we're seeing across the economy, for very prolonged time period. So I think it's important, yes, to be defensive. Healthcare, utilities, staples, those have obviously outperformed to date. But I think you could start to look at growth areas of the market and nibble. So when I say nibble, it's starting a position. So if there's names that you don't own in tech, as an example, if it's a Microsoft or some of the mega cap techs or some of the semi names, I think this is a time where you could potentially look to start a position. Maybe you're adding a quarter to that position today and looking to dollar cost average over the next 12 months. I think it's very important to note that you want to be balanced here, to Bryn's point. You want to be diversified, and I think that is the winning sample going forward in this marketplace.